Hello, my name is Przemysław Kwiecień. You're watching our weekly trading webinar, and today we're going to talk more about gold because the inflation story is starting to pick up around the markets, and we have bond yields rising towards the highest level in a year and starting to have an impact on the other markets. So the question right now, with the inflation anticipation now growing, is gold, that's been struggling a little bit for a while, is gold a proper inflation hedge? This will be our story of the week for today, but traditionally, let's start from the top news today in the morning. We have bond yields rising and having an impact on the other markets, finally, because markets have been ignoring that for quite a while, but still we have very tepid reactions, especially on the FX market, with the US dollar being still very weak. We'll address it later on. This all has gathered momentum after the US retail sales data last week that showed that even though the household just got the $600 checks so far, they already splashed that money around quite strongly, and you can imagine what's going to happen when the Biden $1,400 checks arrive. So as I said, markets ignorant to higher yields so far, especially on the US dollar side. Gold rebounding from the support. We'll talk about it in a minute. So for this week, we have quite busy calendar with info index just in a few minutes. Today, in today's calendar, is usually Monday, it's relatively light, but then we have Jay Powell in Congress on Tuesday and Wednesday. It's going to be quite interesting how and if at all is he going to discuss these rising bond yields. My assumption is he will try to calm markets, because otherwise, if he acknowledges the inflation risk, that would be opposite to what they were doing, and he would contradict himself. So I'd say he's going to stay stubborn, and he's going to hope that any inflation rise will be temporary. So that's going to be their message. On the data front, we have conference board on Tuesday, Reserve Bank of New Zealand on Wednesday, durable orders Thursday, probably the most interesting data, and Friday, monthly data, output, inflation, sales in Japan, and US PC inflation. PC inflation obviously is something that investors are interested in at the moment, but however, bear in mind that we already know CPI inflation for US for January, and that it was relatively low, so I doubt PC will surprise. All right, so let's move on, and before we move on to gold, let's start with what I said was really a driver last week, impact of these Trump checks on the retail sales, because actually what we had until now, these were these $600 checks that were confirmed by the Congress when President Trump was in the office. As you know, after Biden took office, he pushed for more stimulus, which was eventually confirmed by the Senate, and the bigger checks will only arise. So you can imagine, even without these bigger checks, we already have the highest sales growth in the US in nearly 10 years. So with all the inflation sources, let's say, in the pipeline, with companies reporting higher costs, with materials costs rising, with oil getting pricier by the day, you can imagine that these companies will be eager to carry over these higher costs onto customers, and that would cause inflation. So obviously, if demand is weak, then this carryover is obviously difficult. So margins are declining, and companies need to swallow these higher costs mostly by themselves. However, if demand is strong, as it might be in the months to come, even though the labor market is weak, the consumer sentiment is low, but with these big checks and money being spent, companies may be able to increase prices and therefore contribute to higher inflation. One factor that I already mentioned, I think at least once during the past couple of weeks is the rent prices in the US, because it is very important for inflation outlook. Shelter inflation in the US is about 30% of the core measures, be it CPI or PCE. For CPI, it's slightly higher, which is the reason CPI was historically higher than PCE, because shelter inflation usually was higher than overall inflation. However, when you look at this table on the right hand column, you can see that over the past year, shelter inflation, especially in the big cities, declined quite remarkably. And I guess the Fed hoped that even with some inflation, some material energy inflation, food inflation being in place, this shelter inflation will counter that, and overall inflation will remain low. But that might not be the case. The rent costs are already starting to turn around, and the two key models where rents track housing prices, which already soar, and when they track also incomes, where on one hand you have tough labor market conditions, but on the other hand you have huge transfers. So these models suggest that shelter inflation in the US might accelerate in months to come as well, contributing to overall inflation and making this bond yield scare more likely. So overall, why is this important? Obviously, inflation is of great importance for the markets. Here you can see relationship between annual inflation rates and P/E ratio in the US. You might see that for as long as inflation is low to moderate, so let's say to 3.5% annually, the P/E ratio remains quite on the quite high levels, and remains quite scattered across here. So you might say that with low inflation you have high stock prices, high stock valuations. However, as inflation accelerates, these valuation historically were progressively lower, and already at inflation above 4%, they were much lower than at inflation, let's say around 2%. So obviously this is a big reason, even historically, why it's important. But when you add the fact that right now everything is based on cheap money, then I think this relationship is even more important. So let's turn to gold. Is gold a proper inflation hedge? Because gold prices were not doing very well in the second half of 2020, and especially at the beginning of this year. And many people wonder why, when there is so much talk about inflation, why are gold prices not increasing dramatically? Well, part of this belief is explained by this chart, where you can see that in the period of very high inflation historically in the US, you also had gold prices rising very, very sharply. And use the legend that gold is always great when there is a period of high inflation. However, when you look at lower inflation rates, you can see that this relationship is nearly neutral. And also here, the correlation, as you might see, it's fairly random. It was high at the end of the 70s and beginning of 80s, where inflation rates in the US were really high. However, since then, this correlation was fluctuating around zero for a couple of decades. So also, when you look at 3-month gold price changes and the changes in the 3-month inflation over here, you can see that up to 2008, 2009, 2010, pretty much up to the global financial crisis, their relationship was, maybe it wasn't strong, but it was visible. Since then, it's not been the case. One of the reasons why it has changed is that obviously Fed introduced QE in 2009 and stick to it for the majority of time. So with QE, the relationship differs. You have periods of high liquidity where this money seeks some assets to invest in, and therefore other factors become less relevant. So inflation or not, if there is liquidity, asset prices go up. If there is lack of liquidity, if liquidity drains, then obviously this money needs to flow, the flow reverses, and it's negative for asset prices, including gold. And this being confirmed here when you look at the relationship between gold prices and bond yields, which is why we are discussing this today when bond yields are on the rise. When you see on this chart from the 60s, 70s, you might see there was no relationship between gold prices and bond yields. However, here you can see that this relationship is very strong. When bond yields rise, here this change in bond yields is reversed, so decline of this red line means that bond yields are on the rise. You can see that this is negative for price dynamics of gold. So to sum up, if this inflation story, if it gathers momentum, and if it pushes bond yields higher, then obviously it's negative for gold. And here you can see gold prices, and the black line is relationship of gold prices versus 2 years average. And you can see that when gold was at the peak in August 2020, it was 2 standard deviations from the average. Now it's much more neutral, but however it's still above the average, so it's not like gold right now is sharply oversold. Let's move on to the chart on X station. One second, please. Right. So you can see that after a period of very strong rally between, let's say, March and August of 2020, gold's been in a kind of lingering correction, and for a second time in a few months, gold's trying to rebound from the $1,765 level. And right now this rebound looks legit from technical perspective. So there's at least a chance for a short-lived relief rally, let's say this. However, there are 2 problems. First of all, the problem is that back in late November, when gold price was recovering from a similar level, we are also at the lower bound of this downward channel. So there was additional support which is lacking right now. However, the bigger problem obviously is bond yields, which are at much higher level and rising right now. So unless they reverse, this rebound might prove short-lived, and that would be my scenario, that this is mostly a relief rally that can take gold maybe to 1820, something like this, and then I wouldn't really rule out a reversal lower and probably a move lower to at least 1680, because as I said, if this inflation story gathers momentum, then we might be in a position where bond yields will be on the rise and this capital will flow out of the market. The liquidity will be dropping, the investors will be more cautious, leverage will decline. So it should have an impact on so to sum up with gold, it might be a great inflation hedge in the long run. If we have period of higher inflation for many years to come, at the end of the day, gold may do very well. However, in this initial period of negative inflation surprise, I mean negative from the perspective that inflation turns out to be much higher than anticipated, via bond yield channel, it's very negative for gold. So bear that in mind, because it could drag metal prices to much lower levels in medium-term perspective, even though the longer-term perspective might look favorable with all this interest, with the ETF access, with central banks policy that's not going to change dramatically over the long run. Interest rates are probably going to stay low from a historical perspective, even if they increase. So long-term wise, there are still many factors that are favorable for gold prices or precious metal prices in general. However, if this inflation story gathers momentum. Short term, it's not really positive. I mean, short to medium term, because very short term we have just this pickup from here that could take prices slightly higher. All right, so let's take a look how these higher bond yields impact the other markets, and you can see that with the dollar, the impact has been so far limited. So that's a bit puzzling actually, because that should be very positive for the dollar, but that's not been the case so far. You might be arguing that this downward trend is still possible here, because we had this first impulse between early January and early February, and then some kind of correction since then, and we are in a triangle pattern, which technically is a continuation pattern. So we should have another impulse here. And if you look at the bond yields, and if you look at the CFTC speculative positioning, which is very negative for the dollar and positive for the other currencies, and we normally interpret these situations from contrarian position. So this all should support the US dollar, but that has not materialized yet, so we need to be patient here. The levels are quite interesting. We can see a resistance here, it's being defended, but the move there needs to be some move to take advantage of the situation, which is there clearly from fundamentally. And looking at the indices, it also is negative. The rise in bond yields obviously is negative, and you can see the impact today. Actually, at the Nasdaq, looking at the Nasdaq US 100, we see the fifth move lower. We are already at this lower limit of the channel, which used to be a support, or it has been support, because it still might be the case. However, again, if you look at this from the model perspective, this rise in bond yields from, let's say, 0.5, 0.6, which we had in August 2020, to 1.4 that we have now, that should take indices about 20% lower. Right now we have 4% profit taking, so it's still relatively benign, and obviously momentum traders may already look for support here, but more tactical oriented investors might want, again, like with gold, they might want this bond yield scare to occur before they consider entering this market. So far it looks like a breakout is not out of question, and possibility of larger move is certainly there. All right, let's take a look at the calendar for this week. As I said, with quite a lot of releases. Probably this durable orders report will be key. It will be on Thursday. Obviously we buy durable things like TVs, electronics, some equipment when we are confident in our incomes. Obviously the households in the US are not confident, but they are getting a lot of transfers. So if this report confirms what we saw with the retail sales report, obviously it's going to provide more impact to this bond yield scenario. On top of that, we have also consumer confidence index on Tuesday, tomorrow. You can see that ironically, this is probably what shows the biggest divergence between Main Street and Wall Street, with consumer confidence in the US being not that much higher compared to pandemic lows, and the indices being 100% higher. So obviously this is a huge divergence. So this is going to be Tuesday, and then Friday we have PCE inflation. Like I said, obviously inflation right now is the story, but this is a report for January, and we already know that CPI in January was still low, so probably PCE will be low as well. Ladies and gentlemen, so thank you for your attention. I really encourage you to stay with us, tracking the news section in NextStation mobile platforms, and hopefully I'll see you next week on Monday. Have a good week. Bye.